Hi, everyone, and welcome to our fourth installment of BFSG's fall webinar series. Today, talking about life insurance and annuities. I know a fun topic for a lot of people out there.
Thanks, Chad. Hi, I'm Mike Albee. I'm a senior portfolio manager at BFSG, and I've been with the firm for, I think, 18 years now. And happy to be here with everyone, sharing info about annuities and life insurance. Just a little bit more about me. I went to UCLA, go Bruins. Proud parent of two boys who play basketball, so basketball is my life outside of the office. Thank you.
And he's a coach. Don't let him forget that.
Yeah, sometimes.
Hi, everyone. I'm Paul Horn, Director of Financial Planning for Benefit Financial Services Group. Licensed and sold life insurance and annuities for 16 years. Been doing this for about 20 years now. You guys get to hear me on all the fun topics. Last year was taxes. This week is death. So I get to cover all the fun stuff. Thanks for joining, everybody. And Chad, back to you.
Thanks, Mike. Thanks, Paul. Beyond that, I would add, we do not sell life insurance or annuities. This is a session that is truly meant to be educational. I think, will be a unique session for all of our attendees today. And that usually when you hear a presentation on life insurance, it's why you need life insurance and let's go buy this kind of life insurance, and why you need annuities and let's go buy annuities. Today is a very unbiased unbiased perspective. We do not make any money from any of the discussion that you are going to listen to today. We can't sell it to you. It's illegal. And I think the most important thing, it's a comment from Paul, actually, that I heard years ago, is annuities are not bought. They are sold. They are right for some people. They are not right for everybody. But when you talk to somebody that sells annuities, there's always a reason to buy it, right? And same thing for life insurance. And I think the important thing today is that's the second part of today's presentation. The first part is life insurance is, when is it right for you? Is it right for you? And how to know the difference between all of these types of products that you might come across throughout your career. So with that in mind, let me, I think, Paul wants me to kick off a poll to start. We always like to learn about our audience first. So let me launch our first poll. This is the life insurance. Life insurance is the first half of today's prepared remarks, but it should pop up on your Zoom screen at any moment. We do have two polls today, but do you already own life insurance? And if so, what type of life insurance do you have? Just so you can see it. So we got, 29% say no life insurance already today. 34% say yes, we have term insurance, 10% whole life insurance, 5% universal, 16% are various types. And then a good 5% of people here are saying, I have no idea what this stuff even means. So looking forward to listening to what you have to say.
I'm not surprised of those results. Kind of that's what we often see is term insurance. And as Paul gets into it, I mean, most cost effective, and then no insurance. And we'll talk about why people should maybe consider some type of form of life insurance. So,
All right, so let's talk first the reasons to consider life insurance. Life insurance is like any other insurance policy. At the end of the day, we're trying to replace a need, right? If you have an auto insurance, that's to replace a vehicle. God forbid an accident happens. Homeowners, same thing. Insurance, we're trying to protect against a premature death. If that happens, are there loved ones or other people that are going to be financially impacted by that death? So most commonly where we see life insurance obviously is going to be for young families. But if you're 65 plus, there still can be some very good reasons why you still may need some life insurance. Those most common reasons, though, we see are going to be income replacement, right? Let's say let's say you got a family where we've got one spouse that makes 200,000 a year. The other one's got the harder job staying at the home with the kids. That spouse dies with that 200,000 a year income. That's a big hurdle to climb for that family to maintain the same standard of living. So income replacement is the number one reason, because that goes right along with protecting your loved ones. Oftentimes with this too, we'll see situations where maybe we're just trying to pay off some debt. So I helping a couple earlier this week. They have two small kids, 6 and 4. They both make great money. One makes 225,000 a year. The other one makes 260,000 a year. They have a mortgage for 500,000. Other than that, they're in a great financial position. So for them, there isn't a need for the income replacement, but instead the focus was to pay off debts. So for them, life insurance is being used to pay off that mortgage and then cover the cost of college for the two kids. With the idea being there, the other spouse has a fantastic income and could easily survive on that spouse's income. So there isn't this need for the income replacement component. So for everybody, the situation can be very different. And for this income replacement too, another time that we're seeing this right now is, for example, we have a client, she's single, she's retired, she has life insurance. Why? Because she's financially supporting her sister who has some medical issues and needs the extra help. So for her, that life insurance is in case something happens to her to make sure that her sister's properly taken care of. When we talk about life insurance, it comes into two different types. Term is 100% the most common form of insurance out there. It's the cheapest form of insurance. It works like your auto or homeowners. If something happens and you need it, it's there. Hopefully you pay for something that you never use. But the nice thing about term is it is very cheap. If you're 25 years old and get 500,000 in coverage, you're probably spending 20, 25 bucks a month, assuming average health. It's really pretty cost effective here. Term is ideal for individuals that are looking for coverage over a period of time. Think of that young family. Maybe you've got a couple that's 28, 29, 30, just starting out. They've got a mortgage, they've got young kids, they're building their asset base. Well, when they reach, 49, 50, 55, those kids are going to be on their own, or at least in college. That mortgage is going to be paid down. They'll have saved assets. So their needs are going to probably be a lot different in just 1 or 2 decades later. So that's why term is so common and so effective. There is no cash value with it, and we'll talk more about that in a second. But the nice thing is, like I said, it's simple with the term. There's no fancy gimmicks, nothing else. It's just, if you need it, it's there. If not, it's gone. The other type that we see are called permanent policies. With these permanent life insurance policies, these are designed to last the rest of your life. Most commonly, these are going to have a cash value component to them, and we'll talk more about that. But the idea of these policies are more to meet those permanent needs. So if there is, say, that income, say you have a special needs child that's going to need support the rest of their lives, you can get a permanent life insurance policy to help fund that special needs trust for the child, make sure that child's taken care of. Maybe you're well-to-do and you actually have to worry about estate tax issues. Life insurance is a great way to help cover liquidity needs for paying estate taxes. Sorry about that. So there could be a lot of different reasons why you might be looking at a permanent form of coverage.
And Paul, just real quick on that. I mean, those kind of examples you gave with a younger family covering mortgage or college costs or income replacement and kind of term versus estate taxes or special needs, like what we often see is again, what's getting sold is the permanent, not the term. And as Paul will lead into, is that's where commissions are. But in those cases, I mean, again, estate taxes or special needs, I mean, there's other use cases as well, but probably it's a smaller population needing that permanent policy. And when we say permanent, again, Paul will get into it. I mean, we're talking universal life and whole life as well.
Yeah. So we've talked about term. Who is that for? It's the most affordable. It is the most common form of protection out there. If you have insurance through your employer, that's called group life insurance. That is a form of term insurance that you typically have while you're employed there. When we look at permanent insurance, permanent is kind of an umbrella. There's actually 3 separate policies that fall under that. A permanent policy is designed to last the rest of your life. There is a cash value associated with that account. So the most simplistic form of a permanent policy is a whole life policy. Whole life policy, everything's locked in place. How it works is the interest that you grow on that cash value is based on interest rates at that time. Good Lord, Chad. And with the whole life policy, the interest rate's guaranteed for the rest of your life. The payments are guaranteed for the rest of your life. So everything is locked in. It is a really good tool when interest rates are higher. So you're getting a higher interest rate on that account. Or it's really good when you need permanent coverage that you don't have to worry about. Let's say like that special needs trust where you're trying to cover the needs of a special needs child or a special needs grandchild. That would be a common way where we'd use whole life. Otherwise, there are what are called variable and universal life insurance policies. Variable, with this one, it's a little different because you're actually taking investment risk. That cash value is put into a mutual fund, and your return on that cash value is based on how well that mutual fund does. So if we have a year like 2008 and that mutual fund loses 30, 40%, well, your cash value is going to decrease by that 30 or 40%. Variable life are not too common these days. They were more common about 10 years ago, for good reason, because when you're buying a life insurance policy, most people don't want that variability and that sort of risk tied to it. With the last option, it's called an indexed universal life, more commonly referred to IULs. But with an index life, these are the ones that are most commonly sold. If you're 50 to 65, you probably have received a mailer in your mailbox offering you some free steak dinner to hear about life insurance or annuities. These are the ones that they're pitching. So with these index universal lives, they'll tell you that you got linked, your returns are going to be linked to the markets. So that sounds great. If the S&P goes up 20%, you think you're going to get 20%, not quite how they work. And if there's any downside, like 2008, well, with the variable life where you would have that 30 or 40% loss, with the index universal life, your return for that year is just zero. So nothing on the downside. However, you're capped on the upside, meaning your returns are going to be less than you're expecting.
And just
Hey,
to
Paul,
answer that, oh, sorry,
before you
Chad,
leave this, go ahead.
I was going to say that question on the permanent that came in. Permanent is a broad. I mean, it covers whole life, variable life, and index. You can see the coverage is all lifetime. That's what permanent. It's covering your whole lifetime on all three of those. So it's a broad
Yeah, so
category.
I think to that question, when they say permanent, that is the last, like the bottom three versions, like whole, variable, and indexed are all like under that umbrella of permanent insurance. There's just different versions of permanent insurance. And then term life insurance. And this goes to the other questions in there. Guys, for term insurance, because it's a very specific period of time, right? Like 20-year term policy, which is going to last for you until I hit this age. What happens to the money you paid into term when you age out?
Nothing. The
Got
money's
it.
Two
like I
things.
said,
mean,
that's best case example, right? It's
yeah.
like any other insurance policy. You pay for it and hopefully you never use it. I wish the same thing for auto and I wish the same thing for homeowners. Hopefully everybody's happy and healthy and lives a long, long life.
Yeah, and you either let it term out at the end of its term, and a lot of term policies now have conversion privileges. So at that time, you can convert it into a permanent policy at that time. So there are conversion privileges, and you don't have to undergo underwriting a lot of times as well with that. So
Yeah, and thanks for actually bringing that up, Mike. That's a good point I forgot to make. So, real life example for me, I do have a heart condition. I actually don't qualify for life insurance. I did have a small policy when I first got married. That did have a conversion privilege. And since I could not qualify for more insurance, it was just a simple 20-year term I got when I first got married at 25. I still have that policy now, but it's been converted to a permanent policy. So it's something that I'm paying into for the rest of my life because it got switched to a whole life policy. So if you have a policy that's a term, and let's say your needs do get extended, whether it's maybe having another child, maybe buying, more real estate, maybe owning a business, who knows? But if there's a future need for life insurance and you're also not able to qualify, maybe you had a stroke, maybe diabetes, who knows what could have been. Anyways, with that term, you can convert it into that policy without additional medical underwriting. It's not in every policy, but most term policies do offer this.
Yeah. And hey guys, are premiums fixed for life for a universal policy?
Let's hold that for right now.
I love it. Keep it going.
All right. So when we look at the universal life, this is probably the most common one that I see out there. So with your premiums, what you're doing is you're making the payment, and a portion of that is going to cover for the cost of insurance. The other portion is going in to build that cash value over time, and we'll talk more about that in a second. So with these universal lives, the premiums are supposed to be locked in, theoretically. How it works is they will assume a rate of return, and whatever the rate of return that they're assuming on your cash value, that is what's used to help determine the amount of total premium that you're paying. So it's the cost of insurance plus whatever cash value you need to get into to keep that policy afloat. So it should provide lifelong coverage. That's the goal. However, if you have these policies, and let's say they're assuming a 6% rate of return for the cash value put in, but you're only getting 4%, you actually are at risk of potentially lapsing that policy at some point, meaning that policy may run out of money before you pass away. So that is a concern with it. They do tend to have higher fees because the cash value is not guaranteed, and because that policy can lapse or end sooner than anticipated. It does require constant monitoring. If you have an IUL, an Index Universal Life, or a universal life insurance policy, you need to be getting what are called illustrations and reviewing those with a professional every 2 to 3 years. These things will change over time. And if the markets have been really good, like they've been for the last 5 years, maybe you can actually reduce your premiums. Maybe you've had the policy for 20 years and it hasn't had the same returns that they had expected. Maybe you need to increase your premiums to keep the policy afloat. But this is something that's important to monitor.
Paul, one of the things we see often, I mean, when it says lifetime, I mean, often these policies run to what age? 98 or so, like we see often?
Most of them are designed these days to go somewhere between either 102, 105, or a lot of them 120 at this point.
Yeah. Yeah. And that's just people are living longer. But again, you have to make sure, and if you have longevity on your side, I mean, 102 is pretty old, but you do want to make sure that it's not running out early, especially if it's, I mean, if you got a policy for like estate taxes or something like that, that's going to help pay the estate tax because you have an estate tax issue. If it runs out early, then all of a sudden your heirs are paying for those estate taxes out of the inheritance. So something.
Yeah. So let's talk about that cash value for a second. I think this will help everybody kind of understand what we're talking about. So what happens here is this blue line, this is the premiums that they plan. So when you first get this policy, their goal is to have you pay the same premiums for the rest of your life. That's the goal. Make it nice and simple and easy. However, the cost for insurance increases exponentially. In fact, if you look at it, it's almost more like a U, more like that with the curve, where the older you get, it just kind of shoots up. But the idea here is, right, the older you get, higher chance of death. That's why we see the increased costs. With that cash value, how it works is this. In those first number of years, typically for most individuals, we're talking a few decades, you're paying more than the actual cost of insurance. So when you start, your cost of insurance may be here, but you're paying here. This huge gap is going into that cash value account that's earning interest based on, if it's an index IUL, based on market returns, or if it's like a fixed, it's just getting whatever the guaranteed interest rate was at the time of the contract. Could be 3%, 4%. Most commonly, I'm seeing on those fixed accounts. But the idea here is that money's growing on that cash value. But what happens is as you get older, at some point, you're paying less in premiums than the actual cost of insurance. At this point where we have this cross here, this break-even point, what happens there is this cash value is now being used to cover this gap in the future. So if this cash value is not growing like it's supposed to, that policy may run out here. It may not get out to age 105 or whatever the goal is for that end of the policy.
And Paul, on cash value, I mean, kind of maybe let everyone know like how these get sold as an investment kind of vehicle, and
yeah,
what you just explained really doesn't that's
jive with what you're told, right?
Yeah.
So what these policies are sold on is the idea that the cash value is going to grow over time. You can take a loan against these policies. If you take a loan against the policy, that cash value stops growing. If it's done correctly, it can give you a source of cash in retirement that doesn't force the policy to lapse. And if that happens, let's say you have a $100,000 loan on a $500,000 policy, your heirs would get 400,000. So if you pass and you had that loan still outstanding, the death benefit is reduced by that loan amount. So 500 death benefit minus a $100,000 loan leaves $400,000 to the heirs, is how that works. And the problem with that is when you're using this as an investment, it's less than ideal. Number one, because of the very high costs. Life insurance is not cheap. It's expensive. You're probably spending somewhere between 2.5% to 4% per year is the cost of maintaining this policy. Where if you just invested that money in a mutual fund, maybe you're paying 0.25 a year. So the costs are going to be high, which are going to eat into this cash value, slowing down the growth. And then, like I said, if you touch that cash value or you take that loan out, you can force that policy to actually lapse or end with no cash value. For one actual client here, this is a policy that we ran into. What happened here is the client had a death benefit of 1.8 million. This is a very older policy. So their annual premium was supposed to be $10,000 per year. You can see here this cash value over time is supposed to be growing. And the cash surrender value is, we'll talk about that in a second here. But with the cash value, you can see it's supposed to be growing. But then we hit this point here at age 78, that cash value starts depleting, and it starts depleting rather quickly because we've crossed that point where now the cash value is being used to pay for the additional premiums for the cost of that insurance. And what happened here is this policy was supposed to go to 102. Client's parents lived to be 95 and 93, I think it was. She has a life expectancy of 93. And so there is a real concern, because she's very healthy, that she may outlive this policy. Because this policy right now, as it stands, is going to run out of money at the best age 86. It could run out of money sooner if the returns continue to be less than what they had projected. So changes were made here. And what often causes this is these policies are typically ran at really high rates of return. This was, especially if you had an older policy that's 20 years or more old, this was very common in the early 2000s, late 90s. When these policies first came out, they'd run it at like an 8% or a 10% rate of return, where in reality, after fees and stuff, you're typically seeing a rate of return on average on life insurance policies around 3 to 5%. So they're grossly overestimating what that return is going to be. And we compound that over a couple decades, and you can see this problem that's created here for the client. The reality for the client is they are getting a return on this policy around 5.25 right now. So that policy is actually supposed to be lapsing around age 81. So changes had to be made to this policy to keep this in force for the client.
And this is common where we see those hypothetical rates of returns much higher. So what we always request when we look at these in-force illustrations is different rates of returns. Because yeah, always assuming what they just put in front of you, they're always going to make it look the best. So
yeah, this is watched more closely these days. There are more stringent rules around it. So we're not seeing as many, but this illustration is 3 years old, and you can see it's still being ran at 8%, which is not sustainable, unfortunately, in this situation. But again, this is why we want to check on these policies every couple of years to avoid this from happening. So let's say you have an old life insurance policy, one of those permanent policies that were sold to you. The question becomes, what should you do with it? And I get this question a lot. People get these permanent policies. They have them for the rest of their life. They get into retirement. They have enough cash. They really don't need the life insurance. So it's, what should I do with it? Well, one is obviously we can just keep it in force and not do anything. Just continue to make the premium payments and be done. There is an option for what's called a 1035 exchange. And with life insurance and annuity products, sometimes you have a bad product, or maybe you have an old product and there's a newer one that's cheaper and better. You can take the money from the old policy, assuming you qualify for the new policy and underwriting. The IRS allows you to do what's called a 1035 exchange, which is where you take the cash from one life insurance policy and you move it to a new life insurance policy. without triggering any taxes. And so it's a good way to maybe get out of a policy that's more expensive or a policy that's not as ideal and move it into a policy that's going to give you additional benefits or give you a better benefit. So that is an option we see rather common. In fact, I think we're helping a client right now with one of those, Mike.
We are, yeah.
The other option we talked about is sometimes you do build an excess cash value. If you do have that variable universal life with the market returns for the last 8 years, 10 years, you easily could have more money than you need. So I have a client right now that has an old policy for 100,000. They're taking out $8,000 a year that's using to fund their vacations, taken out in the form of a loan because there's more than enough cash value in there. So instead of triggering taxes and taking the cash out, we just take the loan on the policy and they're using that to help cover their travel expenses.
Hey, Paul, before you move on for that, because I have a question very specific to that comment. Do you have a rule of thumb for when it makes sense to cash out? Take the money. So, I mean, this person specifically has a policy with the cash value is like 40% of the face value of the policy. But it's also, they recognize that realizing a portion of those premiums would be taxable too. So do you have just kind of like rules of thumb for what to do with this?
There's so many. So here's the variables that we're looking at to make this decision. One, what stage in life are you? Are you retired? Are you not? Is there a mortgage? Is there not? Are we going back to, is there a need for that income replacement, paying off debts, protecting loved ones? So really the first question here is, do you need the insurance? And when you're looking at life insurance or any insurance out there, we only need to answer 2 questions, okay? The first question is, if something happens, can you afford to pay the bill? If the answer is no, you need insurance, whether that's life insurance, homeowners, renters, whatever the case is. If you can afford the insurance, you can afford if something happens, the next question becomes, if something happens, do you want to pay the bill or do you want the insurance company to pay the bill? If you want the insurance company to pay the bill, then you buy the insurance, whether it's life insurance or disability or whatever. If not, then you self-insure. So I start there, and then we look at what your goals are down the road and seeing what the best use for that cash is, right? It's that old return on investment that we're looking at there, just trying to figure out what's going to give you the best value on that over time.
And the other thing too, just to add is, I mean, you may not take the example, taking the cash out for the travel needs in that situation that Paul mentioned. I mean, you can do a paid up where you reduce your premiums as well, which right down at the bottom. Sorry, jump to it, Paul, but
no, you're fine. You're fine.
Too, yeah.
Yeah. So, and this honestly, for most individuals is where we end up. Most people tend to have, there we go. So let's take this client here for an example. This is what we did here. It was a combination of 2 things. Is we can do what's called a reduced paid up. So reduce means we reduce the death benefit. The death benefit went from like 1.8 million. I think we're around 850,000 on this one for the client. And then what we do is paid up, meaning the cash value that's in there, we're trying to reduce the death benefit enough so the remaining cash value is enough to cover the cost of premiums for the rest of your life, or substantially reduce the cost of premiums. So in her case here, I think we were able to reduce the premiums totally. But another case, I think we had to drop their premiums like 75%, but they still had to pay something to keep the policy in force. So for a lot of individuals, this is where they choose because they don't necessarily need that cash value, or they like the idea of that death benefit. Because remember, life insurance death benefits are tax-free to your heirs. It is single-handedly one of the most efficient and best ways to pass money on to your heirs is through life insurance, because this death benefit is completely tax-free. So a lot of people will look at that reduced paid up option as an alternative as well. Then aside from that, there are times where it just does make sense to surrender the policy. This is just, you cancel the policy and whatever the cash value is, you take that cash value out. We had one client, for example, recently had a policy. They had paid 50 grand into the policy. The cash value is worth 45,000. There's absolutely no need for the life insurance coverage. So in their case, instead of continuing to pay the $2,500 a year premium or $3,000 a year premium, they ended the policy. They took back that $45,000 in cash and used that to help fund their retirement. So it can be done like that. And with these policies, if you choose to surrender the policy, how it works from a tax perspective is any premiums that you paid in, that's your money coming back to you. That's just return of premium. So if you paid in, like the client here paid in 50,000, but it was only worth 45, so they're just getting their money back minus $5,000. No tax implications. But let's say they paid in 50 grand, but the cash value is now worth 65,000. Well, in that case, if the client took the money out there, that 15,000 in gains, that 65,000 minus the 50,000 that you put in, that 15,000 in gains, that would be subject to taxes at ordinary income tax rates. And then there is the least common option we see out there is what's called a life settlement, where you can actually sell the life insurance policy to a third party. So what happens here is these are called viatical settlements typically, and there are investors out there that will buy older life insurance policies and make the premium payments and betting that you're going to die sooner. And so they will give you a lump sum. Maybe the policy is worth 500,000. So for one client, I did this. The policy was worth 500,000, cost 10 grand a year. They paid the client $350,000 cash. Client took the 350,000 cash and moved on with their life. And then the company owned the policy, continued to make those premium payments. And then when the client passes, the life insurance policy will collect that $500,000 death benefit.
It's kind of creepy. They're hoping you die. That's kind of weird.
Yeah. It's an interesting play, I guess.
Yeah.
I guess you can invest in anything these days, right?
You can, yeah.
Okay, so then we talked a little bit about the 1035 already, but this is just where we're taking an old policy, and this could be a life insurance or annuity, and you're going from an old policy to a new policy. That cash value transfers from one to the other, no tax implications. You can do this going from a life insurance to a life insurance contract. You can go from a life insurance policy to an annuity contract. So maybe you've got that policy when you're younger and you have that cash value, and now you're approaching retirement and you don't need that life insurance policy anymore, but maybe the payouts from an annuity could be attractive to you. So taking that cash value from the life insurance to annuity actually is an option. Or you can go from annuity to annuity. What you can't do, what the IRS doesn't allow, is to allow you to go from an annuity to life insurance. Yeah.
Maybe before you move on, guys, because I know we're going to get to the second half on annuities, and that's a good segue, but there's a couple of pretty good questions that are specific to insurance. Let me ask you those, and let's try to keep it brief. I know we're already halfway through, and we got a number of slides on annuities too.
Yeah.
Can you discuss the difference between just when you say cost of insurance versus the term premium?
Yep. So the cost of the insurance and the premium, if we're looking at a term policy, are going to be the same. Okay, so if we're looking at a non-cash value policy, those words are synonymous because there's no cash value tied to it. Okay, but if we're talking about a permanent policy, so a universal, variable, or whole life, then there's two different things going on here. The premium you're paying is a combination of the cash value and the cost of insurance. So that's where here we're paying that money to go into this cash value and that cost of insurance. So that's what the premium is a combination of both. But the cost of insurance is the cost for the actual policy itself, for the cost that the insurance companies have to incur to give you proper coverage for life insurance.
Yeah, let me explain that a little different. So effectively, the premium is the monthly payment that you pay for your insurance policy, right? And if you have a term policy that's worth $1 million if you were to die, then you're going to pay the exact same dollar amount every month for the next 20 years. And hopefully it's wasted because you live longer than 20 years. But if something happens to go wrong, then your heirs and beneficiaries receive $1 million. And it's the same premium every month for that 20-year term. And any of these permanent, right, whole, index, et cetera, that Paul mentioned, the premium is the same dollar amount every single month still. What that premium goes to is to build your cash value over time. And so your premiums when you're young are going to be higher than term, but your premiums when you're older will be less expensive than if you were to buy a term policy at age 60, because the cost of your insurance is, inexpensive when you're 25 or 30 because you're expected to live 30 years, 40 years. But when you're 60, they expect you to die in the next 20 years. So if you try to buy a term policy for 20 years when you're 65 years old, it's going to be a really expensive policy, as opposed to buying it when you're 25 years old. So the premiums for that same permanent insurance are still the same throughout the course of your life. But when you're younger, they're very expensive compared to a term policy. When you're older, it basically takes that difference that you paid to help offset so your premiums can stay the same. But late in life, when it's expensive to buy insurance, that cash value now offsets.
Yeah.
So Paul, can you use that 1035 exchange, right, with the cash value to move to hybrid life insurance with like a long-term care type of rider and front load the premium funding?
Oh, yes. Let's talk about, probably should do a slide on this. Number one, by law, it is illegal to sell a life insurance policy to cover long-term care needs. Not supposed to be able to pitch it that way. However, it is a common sales tactic used by a lot of life insurance agents to try and convince you to buy the policy. And with those long-term care incentives, we'll call them, I would be cautious. I would be very careful on that. If it's from life insurance to life insurance, then yes, you can 1035. But I would be very hesitant and very careful about considering any life insurance for meeting long-term care needs.
I love it. So then last one before we move on to the annuities on the next slide is and this one is for you, Paul, because you already mentioned that you have one. If you have a pre-existing condition,
I do.
Can you qualify for life insurance or are you out of luck?
All right. So life insurance, if you have to qualify for it, right? There's medical underwriting typically. There are some loopholes here that you can do this. So I myself, I work. My wife has the harder job. She stays at home and raises my two kids and has to put up with me. So she has the hard job. And if something happens to me, I need to make sure my family's protected. So for me, like I said, I was diagnosed with a heart condition, I don't qualify anymore. So what I've had to do is kind of piecemeal my life insurance coverage. So employment life insurance up to a certain point typically has no medical underwriting. Most commonly, this is going to be 2 to 4 times whatever your annual income is. So you can get a lot of coverage through your employer and not have to worry about any medical underwriting. Life insurance from an association. So for example, I told you about the policy I have on my own. I have employee, through BFSG, I have insurance. I have another policy through the Financial Planning Association, which is an industry association I've joined. They have a group policy that has no medical underwriting. I have some coverage through them. And then if your spouse works, a lot of times you can get coverage on your spouse for life insurance. So for clients that have pre-existing conditions, it's not one clean, simple answer. It's oftentimes we're kind of piecemealing together separate policies that don't have medical underwriting to get you as close to the amount of coverage that you need that we can viably do so.
I mean, is that too good to be true, Paul? Insurance doesn't require underwriting, or is that just kind of industry? It's part of work and insurance companies are required.
So if it's a group policy, no, it's normal. What happens is the actuaries take a look at the size of the company or the size of the group. If it's an association, they average out and then everybody's paying the same costs. So if you're super healthy and super young, you might be paying a little bit more on a group policy than you would on your own. But if you don't qualify for life insurance, you're going to definitely want to get that sort of coverage. And one last thing I do want to mention real quick, there is a form of insurance out there called AD&D, accidental death and dismemberment. That policy is garbage, and I don't ever recommend it because for that life insurance policy to pay out, it has to be an accidental death. And so I've had a client when I first started in the industry here, was hit by a drunk driver. I can't think of a more accident than that, but there has to be dismemberment as well. Dismemberment is defined as losing your head or losing 2 limbs. If you don't have both of those items, the insurance policy doesn't pay it out. So in my client's situation where it was an accidental death because it was hit by a drunk driver, there was no beheading, no loss of limbs. The coverage didn't pay out.
Eek. And so last one before you go to annuities is, so think about somebody who is 65 years old plus, no longer has insurance, maybe term expired. Is it too late? Not practical? Any guidance? I feel like this is gonna be, it depends. Can you self-insure?
Yeah, this is definitely an it depends answer. Feel free to reach out to us offline. We'll provide our contact information. We're happy to let you know if you should be looking at coverage and what kind. We can even introduce you to some individuals to help you get that coverage if needed. But that's not something I can answer without knowing more specifics. Next poll.
Okay, it should pop up on your screens at any moment as we move on to annuities and leave life insurance, although this is another form, kind of form of insurance. But do you own an annuity? And if so, what type? And I did put at the very end of this, what is an annuity, even though it's not on the presentation screen right now. I think a lot of people have questions. I would go beyond that. I think annuities, even for people that know what they are, have a pretty negative connotation across the world, in that they are very expensive and they are hard to understand. And I think Mike and Paul have a few really good slides that will help explain what these are and whether they might be right for you. Again, reminder, we don't sell these things, and they are probably not right for most people. Let me end the poll. I'll share the results on the screen. We got 77% of people say no. Less than 5% say yes for any of these different fixed, variable, index, various, and 17% say what is an annuity. So I think these will be some fun slides to kind of talk about that.
No, that's great. Get to educate everyone. So, I mean, annuities, as Chad mentioned, I mean, it's a form of insurance. It's a contract you purchase from an insurance company. And in exchange for the premium you pay to buy the annuity issuer is obligated to pay you back either a single lump sum or monthly or annual installments down the road, or sometimes immediate. There's kind of two different kinds of annuities and ways to customize basic annuities.
Yeah, I would say this real quick. Life insurance is designed to cover against a premature death. Annuities were originally designed to help protect against longevity or you living too long, where you give the money to the insurance company historically, and then they turned it into a paycheck for life or kind of like a self pension. That was the original idea on annuities.
Like he said, living too long. He means lasting a long time.
Longevity risk.
Longevity risk.
Longevity risk. And that's a great point, Paul. And like when you choose an annuity, first you consider what is the need of the annuity. Is it to build savings or create income? And then comparing the costs of the additional guarantees, features, benefits, which we'll cover here. And again, if there is a need for an annuity, only paying for what you need. Oftentimes, you'll get an annuity sold to you. You're paying for more than what you actually need. So let's kind of go through the different types of annuities. There's fixed annuities. There's immediate annuities, which you begin making payments to you as soon as you buy the contract. And then there's deferred annuities, which start making payments at a later date. Think of a fixed annuity as like a preset interest rate, kind of like a CD or a certificate of deposit, where you're guaranteed an interest rate for a specific period of time, typically 3 to 10 years. And the longer that is deferred, the higher the annual payouts. But what we saw with old contracts, we'd often see a fixed rate of 3%. Newer contracts are paying between 4 to 6, and that's because of where interest rates were. But think the biggest risk for a fixed annuity is inflation risk. You're stuck at a fixed rate, and if inflation's higher than you anticipate, that's the big risk with a fixed annuity. The other thing that's just important before I move on to variable annuities is with all annuities, they're backed by the insurance company rather than the FDIC, like a CD and that fixed annuity example I gave. While rates are important to look at if you are buying a fixed annuity, the most important thing to look at is the strength of the insurer. If the insurer isn't very strong and they're going to go out of business and you're getting a higher kind of rate, that's something to consider.
Yeah. A lot of times insurance salesmen will give you a insurance from company that you've never heard of because it's paying the best rate, because that's going to get them the best commission, and that's you taking on the most financial risk.
Yeah. Variable annuities, I mean, Paul went through the variable life insurance example where you invest the money. It's the same thing. You're just investing the money in stocks and bonds and different mutual funds. And so your returns can fluctuate based on the market returns that you're receiving. So you carry all the investment risk and have the potential to make or lose money. Variable annuities, we'll get into the example, are typically the most expensive options out there. And then finally, there's index annuities. These are probably the most popular annuity vehicles today, and they kind of have characteristics of both fixed and variable annuities, where the rate of return is based on the performance of some market index, but then that return is typically capped to the upside for some type of protection on the downside or some type of guaranteed minimum interest rate that usually ranges between 1% to 3%. So they have, I'll use the words in future slides, caps and buffers, where a buffer, the insurance company is absorbing those losses up to a certain percent, and then you're capped on, you only get a certain amount of return. Any return above that amount, the insurance company is keeping. And so that's typically what we see. And most of these index annuities, the most popular ones are about 6 years. And they have, oftentimes we see no caps, but then the downside is illiquidity. These are you're stuck in it for 6 years.
Say a lot of that might sound like it's too good to be true. Wait for the examples that these two have, because they are too good to be true.
And that's how they get sold. I mean, it's
Yeah.
you got upside and no risk on the downside. Like, but again, there's never a free lunch in investing. So let's understand the annuity fees. Most annuities are sold on commission, and the commission products come with what's called a surrender fee schedule. And that surrender fee typically is up to 7. We've seen up to 10 years. I've even seen 15 years on a surrender fee schedule.
20 years.
You've seen 20 years, Paul. Yeah.
Yeah, Pete and I just saw 20 years recently.
You did, yeah. So what that means is if you were to try to get out of it in any given year, say something comes up where you go, oops, I needed more than I anticipated. I don't have that savings. I need to withdraw from the annuity earlier. You're going to pay a penalty. That penalty typically reduces each year you hold the policy. But these are illiquid products. And so, and what that surrender is that insurance rep that sold you the annuity got a commission. They got paid out as soon as they sold it to you. This is the insurance company going, oh, I need to claw back that commission because the client's wanting out of it sooner, that we already paid out to our insurance rep. So it's a cover. So really what you're paying on commissions, you can just look at the surrender penalty. That's what you're paying roughly. And just a good tip to know is most annuities allow you to withdraw 10% of the contract value per year without penalty if you're still within that surrender penalty period.
Yeah, it's a great way to get cash out if you have a policy for a couple of years and decide you want to start reversing course. You can start taking this out without triggering those penalties.
Yeah.
Oopsie.
So variable annuities are often the products that sold the most because they tend to have the highest fees than other annuities. This is a real life example of fees and kind of normal what we see. There's something called mortality and expense fees. Those are the general cost to have the annuity. M&E is what they go by. Those typically range between for very low cost annuities, 0.25 upwards to 1.5. On average, we see what, Paul, I think it's like 1.25 is
1 to 1.25 is the average.
Yeah. Then there's administration fees. That's the lower cost, but still additional fee of 0.25. That's, think of all just the paperwork, tax forms they send out to you just to administer the annuity. And then variable annuities, remember, you get to invest in mutual funds, and you take on the investment risk. Those mutual funds typically that you have to choose from, there may be 30 to 60 different mutual funds to choose from. Those funds typically have higher expense ratios than if you go buy a mutual fund at Schwab, Fidelity, Vanguard, whatever. You're stuck in typically even index funds. Like if you want a passive index vehicle, I can go buy VOO, the S&P 500, the ETF of Vanguard for 0.02 or something like that. If I go buy the S&P 500 index fund within a variable annuity, it's still probably about a 0.5% expense ratio. So they tend to have higher expense ratios. On the average we see is about 0.9 to 1% on average.
Yeah.
And then you may get sold additional riders, which we'll talk about here in a little bit, where they offer some type of additional guarantee on the annuity, and those average around 1%. So you may be paying anywhere between 2.5% and I've seen upwards to 5% fees on these variable annuities. So let's talk about riders, and the most common one we see is an income rider example, and we're going to show an example here. But annuity contracts with income riders are also known as a guaranteed minimum benefit rider, are designed to pay annual or monthly income for life, covering either your life or maybe your joint lifetime with you and your spouse, that can be turned on a future date. Income riders are typically sold with deferred annuities. Again, they're sold because higher commissions, and that annual rider fee typically ranges between 1 to 1.5%. So let's look at an example of what an income rider is. So we're looking at, hey, let's buy an annuity for $100,000 with a growth rate of 7%, and that's that column on the right there. And then if you grow 7% on that 100,000, after year one, it's 107,000, and then so on, growing 7%. And then by the end of that annuity term, in this example, we're just looking at 5 years, the payout is going to be based on an age factor. We're using 5% in this example. And based on that end of the value of that income rider at end of year 5, 140,000, you end up with roughly $7,000 per year annual income generated from this annuity with this rider. Versus if you had no rider, the column on that left, the cash value, just kind of building there, you would end up with $6,000.
Yeah.
Paul, anything you want to add there?
Yeah, the income riders, think of it as like a toll road is the analogy I use all the time. So those of us that live in Southern California, we're used to the toll road. You can pay extra money, go a little bit faster on the freeway, hopefully. That's the idea here, where it's kind of pay to play, where you're paying to hopefully get this higher income base. Now, let's say at end of year 5, you take the income, you're going to get that higher base here. So it's doing its job. And this is very common what we see. Where some clients can actually get stuck because if they want to get out, that income base can be much higher than that cash value, kind of locking the person into that contract and force them to take that income long term. But this is what they're designed to do, is provide this income source for you at a faster rate. Just know this income rider is it's not real. This is an accounting method that they use. The cash value is what's real. This is your money in the policy. If you were to cancel it, or if you died and what the heirs got, that's the cash value.
And typically, I mean, income riders, the pros of an income rider is predictable cash flows in retirement, protection against market volatility, and a hedge against longevity risk. The negatives, though, is higher fees can erode into those returns, illiquidity, because most annuities with income riders have lengthy surrender periods, and then just increased complexity. So now let's jump to index annuities and understanding those and the fees. And just remember, like, variable annuities charge explicit fees. You'll see those: mortality and expense, administration, the fund expenses and so on. Fixed annuities tend to offer an interest rate or an income payout net after subtracting expenses. So a lot of people, unfortunately, the way index annuities get sold is, oh, you get all the upside, no downside, and there's no expenses. We all know that's a bunch of BS, the way they get sold. So the fees are actually built into the caps on returns or the illiquidity where you can't get out of it for a certain amount of years. On average, index annuity fees are about 1.25% per year. So less than a variable annuity, as I was mentioning, kind of in that 2.5 to 3.5% range on average. They are cheaper, but there are still fees of on average about 1.25%. But they're just baked in to the caps and the illiquidity.
Yeah.
Go ahead, Paul.
This was a real client's rate of return for 2020. So that monthly cap that Mike's talking about is capped at 1%. So in those months where this client had like this 10.8% return, their return 1%. The insurance company keeps that difference.
Yeah.
That's how they're getting paid on these. But in 2020, for this policy, the S&P return was 15.76. But because the upside is capped and the downside is not capped, even though the S&P did 15.76, our client's return was negative 16. So what did they make when the S&P had a fantastic year? 0.
Yeah. And this was the cap there was no downside buffer on this on a monthly basis, only on an annual basis. Then they summed all these up. And so in a volatile year, in this example in 2020, they walked away with, oh, you didn't lose anything, but you walked away with nothing again when the S&P ended up almost 16% that year.
Everyone, perspective there. 2020 is the year that COVID started. So
Yeah.
we had a really rough beginning of the year, but by the end of the year, the market had fully recovered. So
sorry, go ahead. Yeah, that's a great point, Chad. On this policy here, just so you guys know, when they're doing these crediting methods, it's not from January 1st through December 31st. It's from contract anniversary to contract anniversary.
Yeah.
So for this client, that March and April where we had those 10% downturn months, those were months 7 and 8 for this client in 2020. So you can see those big drawdowns that we had when those lockdowns first happened. And then we see the market recover. But unfortunately, because of these large drawdowns, this is negative 20%. Because of the 1% cap each month, there's no way clawing back from this. The client's stuck at a negative return for the year. Or sorry, 0.
I think, these are complex products. There's caps, buffers I've talked about. The caps, you have to know, they're usually reset either after 1 or 6 years. The buffer, the downside protection, you choose. The smaller the buffer is, the higher your cap will be. The larger the buffer, the more downside protection you want, the lower your cap will be, affecting your returns. The crediting that Paul just mentioned, they're typically 1 year point to point on that anniversary, not calendar year. So there's a lot to unpack when we're reviewing these index annuities. They're not straightforward. And then lastly, the index that it tracks, it will vary based on that index you choose, and there's all different types of indices, not just S&P 500. There's international indices. We've seen inflation indices where they try to tie it to commodities and other things. Like it really matters. The caps, the buffers, the crediting rate, the index you choose.
I'd add to, I think, people that sell annuities, they don't show you 2020 when you made 0, but the index was up 16%. They show you 2008 when you lost 0, but the index was down 40%. And just put in perspective, the index is up more years than the index is down. And so you lose more frequently than you win with a product like this.
Yeah, they sell fear often. I mean, going back to 1926, the market on average is up about 75% in any given year, positive, and down about 25%, going back almost, 100 plus years, or 100 years roughly. So fear sold and going, hey, these index annuities, no downside, but they know that that's why these insurance companies sell these, because they know markets are going to go up more than they go down, and they're pocketing all that extra return that they're capping you on. And lastly, just the other thing to know with index annuities are uh, index annuities don't pay, the index they track does not pay dividends. So if you're, for example, tracking the S&P 500 on an index annuity, you're only getting the price return of that index. Dividends are stripped out of it. So you miss out on the compounding of those dividends. And in this example, we show going back to 1970, the S&P 500, if you did not reinvest those dividends and compound that growth, you see the blue line is the growth rate during that period of time, and the orange line is if those dividends were reinvested. And dividends have been an important part of stock market's total returns. Going back to the early 20s, they've accounted for approximately 32% of that total return of the S&P 500. And you're stripping out, when you buy an index annuity, dividends.
What are you looking at? Somewhere between what, 2 and 4% every year, just in dividend return?
Yeah, I mean, historically, yeah. I mean, today's on the S&P 500, dividends are less than 2% today. But yeah, historically, yeah, I call it, yeah, 2 to 4%, or if you're in the US or outside of the US.
So to make it really clear for everyone, this is orange is the one we want to be tracking. Index annuities are tracking this one.
The blue,
Just to
yeah.
be very clear.
And again, not annuities, there may be a time and a place to get an annuity. If you are really afraid of taking any market risk, and it's probably, if you can find, there are lower cost annuities options out there, it's probably better than sticking out of the mattress,
Yeah.
and not outpacing inflation. So there's a time and a place where annuity may make sense. For, again, maybe you need some type of fixed income gap, a guarantee between retiring and before you start Social Security. There's a time and a place for annuities. So
Yeah, I mean,
not all annuities are bad, but just we're trying to show you, like, hey, these things get sold, and here's some things to consider.
yeah, I mean, real life, we helped a client with annuity a couple years ago. Client had enough funds to retire on. Someone that's just more conservative by nature, a little bit risk adverse, had more than enough money in stocks and bonds for the rest of her life. And she had extra money and she didn't want to put it in the market. So for her being more conservative, what we did is we put a little bit of money into an annuity for her to give her additional income stream that's guaranteed the rest of her life, provide her that safety net. And by doing that with the annuity, we kind of use it as like a bond proxy that allowed us to invest a little bit more aggressively in stocks for her. So her portfolio is up even more than it would have been if we hadn't done the annuity to begin with.
And I know I was trying to go through those slides quick just to try to keep us on track, because I know we're a little bit past the hour. So last slide on the annuities is taxation. I know I saw a question in there in regards to capital gains and taxes on annuities. Much like a 401k, annuity investments grow tax deferred, but then withdrawals are subject to ordinary income. There's no capital gain treatment. So everything's ordinary income. It's only on pre-tax funds. If you buy it in like a retirement account, they're all taxable. On after tax, only the gains are taxable. And those gains, not to get too into the weeds on taxation, but the last in first out rule applies on those gains, on how they're taxed, the LIFO rule, which we have there on the slide. What we often see is annuities being bought with in retirement accounts. You're losing out on one of the key benefits of annuity, is that tax deferred growth, because that's already a tax deferred vehicle that you're buying it in. So you're stripping out that benefit of annuity. So we typically, if you can, avoid buying an annuity in a tax deferred account. Paul, anything you want to add there on any of the other taxation?
No, yeah, no, just if you do invest in the annuities, it's tax deferred growth, yes, but it's taxed as ordinary income coming out. Or if it was invested in stocks and bonds, it would be long-term capital gains. So
Yeah.
you do have that higher tax rate to offset the benefit. And if you pass away and you pass the money on to your heirs, there's a step up in basis on money invested in stocks and bonds. So if you're in stocks and bonds for 500,000 and your heirs want to get that money and use it, sell all the investments and use it, there's no tax implications for them. But if you have 500,000 in annuity, there's no step up in basis because of that tax deferral. So it will create more taxes for your heirs as well.
Yeah. So life insurance, no taxes upon your death to your heirs. If you own stocks and bonds in a brokerage taxable account, they get a step up, no taxes. If you own a annuity with after tax funds, the gains are still taxable at ordinary income to your heirs. And I'm dealing with a client right now, and unfortunately his mother passed away, and I've received an inheritance for 2 annuities, and each annuity's got about a $285,000 unrealized gain that we're looking at. And so going back to what we're doing is we're doing that 1035 exchange where we're moving it from higher cost annuities to a lower cost annuity because we don't want to incur that gain all at once. So we've also just put some additional resources that we've produced, short videos, some blogs and so on, and then just other resources. The complicated risks and rewards of index annuities, that's right from FINRA, the regulatory agency, kind of saying how risky and complex these can be.
Yes, and so to that, so all those resources, obviously, they're links in the PDF that these guys are presenting right now. I did post in the chat box that everyone on the call should be able to access. I do have questions in the Q&A box, so please do type further questions in the Q&A box instead. But if you do want some of those resources, if you open up that chat box, there is now a link to the survey. Let us know what you thought. And again, future topics you want to hear when we come back for our summer webinar series next June or July. As well as a link to all of the slides that Mike and Paul went through today. So if you want some of those extra resources Mike just had on the screen, if you click that link for that PDF, I don't think you can copy it out of Zoom, but you could just click it. It'll pop up in your browser, and you should be able to download the PDF deck for reference at a future date as well. Again, all of the contact information for Mike and Paul is on the screen. Definitely reach out at financialplanning@bfsg.com if you have questions on any of the topics discussed today. Or I know there was some, I typed it back to somebody in the Q&A box. If you need, assistance with some of those illustrations, definitely reach out and these two will connect with you. Mike and Paul, let me get to some of the questions in the Q&A box right here. So index annuities seem similar to structured notes. Can you talk about the difference?
Yeah, they are very, very similar with caps and buffers on a structured note. The difference is on an index annuity, you're taking the risk with an insurance company. And looking at the credit quality there on a structured note, you're taking the risk with typically a financial bank institution, if that's Morgan Stanley or Wells Fargo or whoever's selling you the structured note. So that's one of the key differences. The other is the tax deferred growth on an annuity. You're getting that tax deferred growth. On the structured note, you are not.
Yep.
So I would say those are the two big things. Paul, anything I missed there? I think those are the two main things.
Yeah, I mean, one's done with the bank. It's just the bank's way of trying to cash in on the annuity craze.
Yeah, they're very similar though with caps and buffers and so on.
So do we pay long-term capital gains tax once an annuity matures?
Nope. You pay ordinary income.
Yeah,
That's
so definitely
the drawback. You get that tax deferred growth, but on the way out, you're getting taxed. Death and taxes. Paul talked about taxes last week, and the death piece of it. There's only two certain things in life, and the IRS is going to get their keep eventually.
Yep.
Yeah, I guess. I mean, I had a client years ago that bought into inside of their retirement plan, into an annuity product and paid an extra 1% premium, just because they wanted the downside protection. The unfortunate thing for this person is, had they bought just the regular balanced fund that was 60% stocks, 40% bonds, same allocation without that extra 1%, their account would have been like $500,000 instead of $250,000, and they could have withstood a 50% decline in the market.
Yeah.
50% decline would have put them at the same place that their annuity product was valued at the time they retired. So it's a hard thing to think about, but again, it's the guarantee that this person wanted, and for them, peace of mind was worth it.
Again, and that may be the case, and these are very specific for each individual.
So next one I have for you is, are annuities only good for younger adults? Risky waste of money for older person, think 65 plus? Or maybe
What
is
do you
it the
think,
opposite?
Daniel?
So annuities were designed, like I said, originally to be an paycheck for the rest of your life. So annuities would go back hundreds of years, back to Roman Empire times, I believe, was the first one. But with the annuities, like I said, you give the insurance company the money, it's supposed to be a paycheck for the rest of your life. So historically, they've been better for older individuals. The people that are most frequently targeted are going to be those close to retirement age, trying to get those 401k assets and get those put into a annuity instead of investing in like stocks and bonds.
And I would say, I mean, younger individuals typically don't need an annuity, if you are considering one, because you have so much time. Your time horizon's long to withstand even if the market goes down 50% next year, you have time to recover. And again, based on historical market returns, there's not really a need for an annuity at that point.
No, and most commonly where we see the annuity or people that are kind of the ideal scenarios are those that have that income rider that can take advantage of this guaranteed growth for 7 or 10 years out. This is most commonly where I'm seeing annuities being a net positive for individuals. So maybe you're 7 years from retirement and you want to get that additional growth to get that guaranteed income for a portion of your money. That's where the annuities tend to be most attractive from what I've seen with individuals.
Yeah. I would say between 50 to 65 is where you see most of the action.
Yeah. So what I'm actually hearing from you guys, it's the opposite of the question, right? Younger adults don't do it. You got, time, you have earnings from your job, you have human capital, the ability to grow your earnings over time, and just longevity. When you get close to retirement or into retirement is when these things might make sense. But again, really dependent on your situation.
Yeah, I mean, just think of it from this perspective if you're younger. The underlying investment is always stocks and bonds. It's just, are you taking the investment risk or is the insurance company taking the investment risk? You have to pay money to the insurance company if you want them to take that investment risk. But the underlying assets are the same. So if you're younger, why do you want to pay 3.5% fee per year when you can pay nothing and get exposure to the same upside?
Yeah. For 50 years, paying 3.5% per year.
That's expensive.
Really expensive. Yeah.
Well, so the next one I have, and it kind of goes to this one too, and it's got a thumbs up because it jumped to the top, is, are you making the point here that we should just draw down from our corporate, retirement account, like 401k, 403b, et cetera, and not worry about other investment options?
No, nope. Time out. Time out. All right. So number one, we are not given any specific investment advice of any kind. We are merely wanting people to understand the pros and cons of these products. There could be a very strong case that life insurance or annuities might be a very wonderful product for you to invest in. Outside of that, we haven't even talked about other options like real estate investment trusts. So talk about real estates, alternatives, gold, crypto. We haven't talked about anything else. Just purely focus on right now the education piece and where it might fit or where it doesn't fit in your financial puzzle.
That was it depends on your unique circumstances. We cannot, yeah.
It is. I think for some people, right, that could make sense, right? Like, your company pays you and your salary and you get a W-2 every year. And maybe you grow your 401k enough and you retire and you can just take a monthly check from your 401k. And instead of a W-2, you get a 1099.
And I would say that's actually not the ideal way to go because because now you're just creating another tax time bomb. So you have all that tax deferred growth. So your tax rate in retirement is going to be the same tax rate. And we talked about this last week on the tax webinar where we have these people that have these huge 401ks or 403bs, done a fantastic job savings, but it's all tax deferred. So you're just kicking the tax can down the road, creating another problem for you in retirement. I would challenge, if you're going to do a good job saving, you want to have both. You want to have taxable and tax deferred and Roth ideally, so you can control the taxes and pay as little bit of taxes as possible in retirement.
Yeah. That tax diversification, having a tax-free bucket, tax deferred bucket, and taxable bucket is, we think, really important. Just like how we manage portfolios, diversification, we want tax diversification too, because then you have different levers to pull again, for your situation.
Yeah, I need to go find it, but I'll drop in the chat box in a second a link to me and Mike's video on pre-tax versus Roth for all of you saying, wait, what's Roth? If you have access to Roth accounts, and most of you, especially if you're employees of clients at BFSG, you do have Roth in your 401k, 403, or 457 plans. It's a very powerful tool. Next question I have for you all in our Q&A box is it a good idea to have life insurance and an annuity? And if you had to choose between the two, which is more secure? This person recognizes it depends on your person's situation, but if you could, kind of extrapolate.
Yeah. So on this one, again, it goes back to what is the primary goal for this money? Are we trying to protect against a premature death? We want life insurance. Are we trying to protect against making sure that we don't run out of money in retirement or wanting income in retirement or growth on that money? Then we might want to consider an annuity. So the answer there is very, number one, dependent on what your goal is that you're trying to accomplish with that bucket of money.
And there may be a need for both of those, covering different periods of time, or again, if you're buying some type of permanent whole life or universal, lifetime need for life insurance and an annuity for that income in retirement. So it's very unique to your circumstances.
Yeah. Something to keep in. Sorry, go ahead. We can go to the next one.
Yeah. So the next one I have for you, I mean, this is really, I think something actually happened. An insurance agent tried to sell something to somebody here. An insurance agent tried to sell an annuity as a way to protect assets to save now and pay for college, 8 years down the road. Good or bad idea?
Bad idea. So let me make this clear too, because we didn't really cover this. There's different licenses within our industry. There's those that are able to sell investments like mutual funds, stocks, and bonds. And then there are those that are only able to sell insurance products like annuities and life insurance. And so I see this a lot, especially from agents from places like Northwestern Mutual, New York Life, not picking on them. This is just a trend that I've seen. But you have these agents that are only licensed to sell annuities and life insurance. So every single problem that you have financially has to be solved with life insurance and annuities. Think of your investment, all the options out there, the stocks, bonds, mutual funds, everything that we've talked about. Think of it like a pie, right? We've got 10 to 12 slices in that pie. Most of these individuals can sell you 2 or 3 slices, not the whole pie. You want someone that you're working with that can sell you the whole pie so all the pieces are working together appropriately.
Or work with others that can then, because again, we don't sell insurance, we don't sell annuities, but if there's a need, we identify it, we go to a broker, let's go find the lowest cost annuity if there's a need, or let's go to an insurance agent and get you a insurance for what your needs are. So it's taken kind of a one, like in that example, college costs. There's probably way better ways to save for college than within an insurance product.
Yeah.
I think this particular person, they say, they try to sell it with the idea they have a shorter time horizon paying for college tuition in the next 8 years. Yeah.
And then you got the tax implications and surrender penalties.
Yeah. Surrender penalties, tax implications. Again, at 529 structured, where you're gonna get tax-free growth on that, and just structure it the right mix of stocks and bonds to help protect on the downside. Probably a much cheaper, more liquid, and tax-free growth than doing an annuity for that.
Excellent. Thank you too. Paul, can you put up that thank you and that disclosure for Mr. Albee up there? That was the last question we have from everybody today. Again, thank you for everybody for sticking with us, and hopefully you found the content and the presentation today educational. Again, there is a link to the survey, a link to the PDFs, and I did post for anybody questioning what is the difference between pre-tax and Roth, a link to a YouTube video. I think it's only like 4 or 5 minutes that Mike and I did a while back. That kind of talks about the difference and the benefits of saving in a Roth account. Again, thank you all. Mike and Paul, any closing remarks?
Thanks so much. If you guys have that old policy and have questions, feel free to reach out. We're happy to talk offline.
Yeah. Thanks for bearing with us through 4 weeks of financial literacy. Thank you.
Again, we'll be back again for our summer series. Stay tuned. And if you like to get I think we do every other month a update from our financial planning email just click yes in that pop-up that pops up at the end of the Zoom webinar. Thanks, everyone. Have a great afternoon.